Thank you, Nelson. I couldn't have done a better introduction if I'd written that myself. Nelson failed to mention that I actually started my collegiate career at the University of Michigan in sports management, and I want you to know I did get an A in sign stealing 101. So back then they actually started teaching. Of course, they didn't have video phones at that point. We all had to take notes. I noticed in the Blade in the last couple of days that several banks, competitive banks, have held these kind of economic forums. And I went to both of those that I saw last week, and I did steal some of the ideas that they had from that. So I have been able to use that material well. Today we're going to talk about what we see happening going forward in terms of the U.S. economy and the likely path for interest rates in 2024. And we try to do this at year end as people and your own businesses start to think about what kind of conditions you'll be dealing with as we go through 2024. It's interesting, I didn't have to change this slide from last year other than the date, because a year ago at this time we were talking about the same question. Is there going to be a recession in 2023? That was the debate that we were having at the end of last year. Here we are a year later, at the end of 2023, and the debate is, are we going to have a recession in 2024? And if so, how deep or how long might that recession last? So it made it much easier for me. I get paid the same, whether I have to change a slide or not. So this worked out well. You know, the other thing I noticed, this is off the subject. If anybody owns stock in a company that makes neckties, you might want to think about getting rid of that. There's only 2 neckties in this room. Nelson and I are the only 2 people who have neckties on. I think neckties have kind of gone the way of buggy whips. We just don't use them anymore. The world changes on us all the time. In fact, this may be the last time I wear a necktie. Until somebody's coming in for a viewing as opposed to listening to me. Thank you. I appreciate a laugh on that. At any rate, what's going on in today's world is, hello, I get dings. Oh, here we go. Hit the right button. We have a war. You've all read about this, right? We have a war going on. And the war we all hear about are the wars in Ukraine, the Middle East. Several other developing nations are having tremendous political conflict. I term what's going on in the United States from an economic standpoint as a war. And the war is between 2 factions. The war is between the Federal Reserve and Congress. And the outcome of that war will decide what 2024, 2025, and beyond look like. Right now, we're in a little bit of a ceasefire in the war because we have something called the debt ceiling. And the debt ceiling limits one side of the conflict, the war here, from firing any missiles at the other side. And that is that Congress can't pass any spending bills because we're up against the debt ceiling. And even the agreement that was reached over the last couple of days to move the debt ceiling debate down the road into January and February doesn't relieve us from that war that we're fighting. And so what I want to talk about a little bit today is how that war is going and what I see the conflict as we go forward. I put this chart up here because this is a personal consumption expenditure price index. This is inflation. And I went back to 2010 after the Great Recession when the real estate markets collapsed and all of that, and looked at what we experienced for an extended period of time, over 10 years, where inflation was very modest. I mean, we lived in an economic nirvana. It was perfect. It was paradise because we had an economy that was growing about, on average, 2.1% real GDP growth over that 10-year period, and inflation was actually under 2% for that 10-year period. That's an unheard of environment to last that long with continued economic expansion and at the same time, very little inflation building up. But obviously something happened here in 2020, 21, as you can see, inflation skyrocketed. And of course, what happened was the pandemic. We shut the economy down, and at the same time, we did some other things I'm going to talk about in a minute, but the reality is we shut the economy down. We were not producing goods. So anybody who was buying anything was watching a shortage of supply, a real imbalance between supply and demand. And that imbalance, of course, lasted all through the shutdown in the pandemic and extended out beyond it as we tried to restart an economy that takes just some time to do that. The net result of that is a pretty significant increase in inflation over that time frame. The Federal Reserve reacted to this, and their reaction was inflation's too high. When we're running 5 or 6 or 7% inflation rates, PPI actually got up to 9% at one point, year over year. The Fed became very alarmed, and their reaction was to do what the Fed always does when inflation is skyrocketing, and that is to try to dampen demand. We need to slow the spending. We need to slow consumer demand, and we'll do that by raising interest rates. Now, the rate I've put up here is the Fed funds rate. Not everybody follows that rate very closely. This is the rate that banks borrow from each other. So it's the rate that the Fed manages and drives market rates to follow. So we saw 11 increases over a 18-month time frame, with the Fed funds rate going from 0 to 0.25% all the way up to its current level of 5.25% to 5.5%. So we saw a 500 basis point, 5 percentage point increase in the Fed funds rate. And the Fed was trying to get interest rates high enough that people didn't spend as much. Their demand went down, that we'd get a better balance between supply and demand. Now, at the same time, supply was increasing. We were solving some of the supply chain problems, distribution problems. Companies were got up and running again and began to produce goods. So one would expect that, all else being equal, what would have happened here is that the Fed's action would have created a significant slowdown in the U.S. economy and a significant increase in unemployment. Now, the Fed has a dual mandate from Congress. Congress, by law, says the Fed is to conduct monetary policy in such a way as to promote full employment and maintain price stability. No inflation, employment remains steady. That's their dual mandate. The Fed's attitude was, we're willing to sacrifice employment at the expense of getting inflation price stability back in line. The Fed has said their target is 2%. 2% inflation rate is what we think is reflective of a healthy, growing economy. You're going to have about a 2% inflation rate in that environment. That's their target rate. They have repeatedly said they are not going to abandon that target. That 2% target is a hard and fast target that they're committed to trying to achieve. So, historically, this is an unprecedented increase in rates by the Fed over a very short period of time. One would have expected to see an impact on the U.S. economy as a result of that. So, for example, at the end of, put this slide up here, this was actually from last year too. At the end of 2022, I went back and looked at what the consensus forecast was of all economists, because all economists look at every other economist and what their forecasts are and try to figure out whether they're above or below or whatever. It's kind of a peer group comparison. But at the end of 2022, the consensus forecasts that we track closely said that we would see a decline in real GDP in the first and second quarter of 2023, and that we would get a modest growth in the third and fourth quarter. That the U.S. economy would actually decline in 2023. That was the forecast. Show you how good we are as forecasters. Here's the actual result. The consensus forecast absolutely missed it. The economy grew at better than 2% the first half of the year and then skyrocketed to a 4.9% rate of growth in the third quarter of this year. So we're nowhere near where the Fed thought we would be as a result of what they characterize appropriately as restrictive monetary policy. And the Fed's dilemma today is, what's wrong? Why isn't the economy reacting the way it should, given what they've done with monetary policy? The Fed uses something called the Phillips curve. For anybody who tracks this stuff, it's kind of interesting, I guess. This might be characterized as in the weeds, so I apologize. You might want to nod off for a minute or two. The Phillips curve is a theory that says there is a stable and inverse correlation between unemployment and inflation. And this theory is the basis of all of the Fed's models. All of the computer modeling the Fed does that helps them with forecasts is based on this Phillips curve concept. So it says, for example, if inflation goes up to 5%, unemployment will drop to 3%. That if inflation goes up to 6%, that we will see unemployment up around 6%. Didn't happen. In fact, the curvilinear result of historically following the Phillips curve has been thrown out of kilter in the last 2 years. In fact, the Phillips curve today is almost vertical. It doesn't matter what inflation is, unemployment has remained stable. So we've seen no movement in the unemployment rate in spite of the significant increase in inflation that occurred. And the Fed is at its wits' ends trying to figure out why not? What happened? What's wrong with the Phillips curve concept? Do they have to go back and rethink all of the basis for their modeling? Okay? Because as we can see, the core PCE price index has declined. This is the measure that the Fed defines as the 2% target. The core non-food and energy price increase in personal consumption price index comes out monthly at the end of each month for the prior month. So we don't have October's number yet. It only goes through September's, the last month we have the data for. But as you can see, inflation has come down. This measure of inflation was, on a year-over-year basis, was up 5.1% in June of last year. It came in at 3.7% in September of this year. So inflation has come down, and that would indicate that the Fed is winning the war, that the effort they're making to slow the demand side of the economy down with higher interest rates is affecting pricing. But in fact, the demand side hasn't slowed. I mean, when you get a 4.9% increase in real GDP in the third quarter with personal consumption expenditures, which are 70% of our total economy, and that grew at 4% for the year, for the quarter, I mean, clearly the demand side has not slowed and has not slowed. Now, the belief is it's about to slow, and we'll talk a little bit about that in a minute. But at this point, it has not done it. So the result is you end up with PCE price index declining, unemployment, the yellow line, the unemployment rate staying very low and fairly stable. Phillips curve's out the window. Didn't work. It's not working. Why hasn't it worked? Well, first of all, real personal consumption expenditures have not slowed. People are still out buying. There's a whole lot of consuming going on out there. People are still buying things, and they're willing to buy things to continue to grow the U.S. economy. In fact, in September, the last month we have the data for, a 0.4% increase for the month translates into something like a 5% growth rate annually in personal consumption expenditures. Again, that's 70% of the U.S. economy. So that process certainly hasn't worked. Inflation hasn't come down because the demand side has slowed the way the Fed expected it to. Consumer confidence in this environment we're dealing with today has actually kind of maintained itself. Yes, it's off the peak on the index, and I use the Conference Board's index because it's been around the longest, peaked at about 130, and the last reading we got in October, it was at 102, but it's actually up a little bit from where it was a year ago. So we've actually seen consumer confidence levels stay relatively high. What's not high is business confidence. If you look at any business confidence survey, businessmen are extremely concerned about next year. They're very afraid of what's coming down the road. It's consumers that are not. Consumers are generally, in spite of all the election polls we read about and the fear that consumers have, voters have about the current condition of the economy, consumer confidence has been maintained fairly well over this time frame. So this doesn't portend a dramatic drop in consumer spending, consumer final demand coming our way anytime soon with confidence levels up. Non-farm payrolls have grown. Yes, the rate of growth has slowed. The average on a 3-month basis is a little bit under 223,000 a month. That's down from 280,000 a month on a year-over-year basis, but it's still growing. Jobs are still growing, and the JOLTS index, which is the measure of posted and unfilled jobs in this country, has held up well over this time frame. It's down from above 11 million jobs, posted job openings that are not filled, to 9.5 million. Historically, that number runs closer to 5 million on a normal economic environment basis. So by any measure, the consumer side of the economy remains very strong. There's no indication it's slowing. Well, as a result of the Fed's efforts to raise interest rates and slow the economy, we can see what's happened to market interest rates. And here we go back to December of 21, prior to the Fed's beginning to raise interest rates in March of 22. Okay? And as you can see, a 2-year Treasury had a yield of 0.4%. A 10-year Treasury had a yield of 1.5% back then. Why anybody would lend money for 10 years to the U.S. government and get 1.5% on your money was beyond me. I mean, that does not make any sense. But that's how low rates got. Now, the Fed, as a result of the action they've taken, has resulted in this change in the yield curve. And as you can see, the red line is as of October 31st, and the yellow line is as of yesterday's market close. You can see the dramatic change. Where did the change occur? It occurred on the short end of the curve. We have what is now called an inverted yield curve, where the yield on short-term treasuries is higher than the yield on intermediate and long-term treasuries. That's an unsustainable position. It cannot last. Something has to change. Something has to give to correct this inverted yield curve. There is a value, there's a risk, I should say, in lending money longer term than there is in lending money shorter term. And if there's higher risk, you ought to get a higher return if you're willing to lend money on a longer term basis. As of right now, that's not the case. You get paid more by staying short. And we've got this inverted yield curve. Now, the inverted yield curve has narrowed somewhat as recently as the end of July. The spread, what's called the TED spread, which is the spread between the 2-year and the 10-year yield, was 105 basis points. So the 2-year Treasury had a yield 105 basis points above the yield of a 10-year Treasury. That got down to as low as 12 basis points in the late October, just less than 3 weeks ago, and has now widened back out to about 45 basis points with the movement in the market in the last 10 trading days. The point is, it's still inverted, and it can't continue to be inverted, okay? So the Fed's looking at an environment where the Phillips curve doesn't work. I've got this inverted yield curve, which shouldn't happen. Something's wrong. Something has caused the U.S. economy to act much differently than it has historically to monetary policy decisions and actions, okay? What's gone wrong? The war is with fiscal policy. While the Fed was trying to slow the economy down by raising interest rates, slow demand side down, what were we doing with fiscal policy? We were pumping trillions of dollars into the economy. All of the stimulus programs that we've passed in the last 2 years have created this huge stimulus from a fiscal policy standpoint, which offset the restrictive monetary policy positions the Fed was taking. Now, you'll never hear the Fed say this, because the Fed will never criticize Congress, because they view that as getting into the political discussion, and they avoid getting into politics and a political discussion as much as possible. But the reality is, you can see what we've done here. We have a huge gap between spending and revenues that we're pulling in. This is a percentage of GDP, and as you can see it, the blue line, the revenue line, has held fairly constant for a long time as a percentage of GDP. Some ups and downs, tax rates change and we made some law change, but basically it's been fairly flat. What's happened here is beginning in 2010 with the Great Recession, when we pumped in a bunch of liquidity and stimulus programs, and then again in 2020, which is the last year the government's published all the numbers, it widened out. And in fact, the better way to look at it is look at the federal debt outstanding. We're now at $33.2 trillion of federal debt outstanding. That's up from where we were in 2010 of $11.9 trillion. So we've tripled the amount of debt, federal debt outstanding, in the last 13 years. Huge stimulus, and you can see that a lot of that stimulus increase in debt came from 2020 and beyond. 2019, we were at 22 trillion. Now we're at 33 trillion and growing rapidly. In fact, the third largest expenditure in fiscal, the government has a fiscal year of September, but so when I say the fiscal year this year, the third largest expenditure by the federal government will be interest costs, carrying the debt. And that's with the fact that this 33 trillion, a lot of it was issued in a low rate environment. Right now, the cost of that debt to the federal government is a little bit under 3%. However, they're going to have significant maturities of low coupon debt maturing over the next 3 years. That debt, if rates stay where they are, will have to be replaced at 5% or more. So it's projected that within 3 years, the largest expenditure by the federal government will be interest carrying cost on the debt. Will exceed defense spending and Social Security. That's how much we've increased the debt. And as a result, we're now at a point where the federal debt is 123% of total real GDP. That means if we just took every dollar that everybody spends, companies, individuals, everything else, and instead of spending it, we sent it to the government, we still wouldn't be able to pay, for 1 year, we still wouldn't be able to pay off all the debt. Now, I don't know about you, but I don't think I can get through a year without eating. And I don't think I can sell my neckties to anybody and try to raise revenues doing that. So obviously that's not a solution, but the reality is this is the condition we found ourselves. The war has been between the Federal Reserve and Congress. Congress continues to spend money and they borrow it to do it. And that's an unsustainable situation we're in. And it's unsustainable because at some point, people are going to say, you know what, I'm not going to lend any more money to the US government until they get their fiscal house in shape. We've started to see a little bit about that. If you look at the auctions that took place over the last 3 weeks as the government did its quarterly refunding, they have been some of the weakest auctions we've seen. The bid to cover ratios in those auctions were alarmingly low, which means there's less demand for treasuries. Now, this is only going to get worse. Who's the largest buyer of US treasuries? What entity in this country buys treasuries, the biggest treasury purchaser? Anybody know? The Fed was. The Fed, in fact, took one of the things the Fed did is added to the problem, because if you recall, they did a QE program coming out of the pandemic where they expanded their balance sheet from $4 trillion to $9 trillion. And they did that by buying treasuries and mortgage-backed securities and some other securities, but that pumped $5 trillion of additional liquidity into the system. The Fed made that mistake too. along with Congress and all the stimulus programs they did. But the Fed is not a purchaser now because the Fed is now letting their balance sheet shrink. And they're shrinking it by $95 million a month. They have $95 million a month of securities maturing that they're not replacing. So the Fed's not a buyer of treasuries right now. Who's the biggest buyer of treasuries?
Banks.
Who?
Banks.
No, banks are not. China, that everybody says China's doing. See what Chinese had to say in San Francisco yesterday. I don't think they made any commitment yesterday to buy treasuries. The biggest buyer of U.S. treasuries, and this is who lends money to the government. You buy a treasury, you're lending money to the government. Social Security, who said it? Social Security Trust Fund is by far the biggest buyer of U.S. treasuries. In fact, they're the largest single owner of the $33 trillion of securities that are out there already. Social Security Trust Fund is the largest single owner. They have about $7 trillion of it. Second biggest owner, pension funds around the country. So, and they have about $4.5 to $5 trillion. So somewhere north of 11 trillion of the 33 trillion is owned by retirement programs, either private accounts or the Social Security system. What happens if we start to default on those treasuries? What happens if we don't raise the debt ceiling and we can't raise money to pay off the maturing treasuries? We default on them, right? That means Social Security checks don't get sent, or if they do, they're significantly reduced. Now, the good news in that is that the riots in the street would be fairly peaceful because it's hard to have a violent protest if you're in a walker. So you can't throw bricks very far. I suppose that's the good news on all that. But the reality is that's where we'll see that happen, this pressure unfold first, is if we don't do something about the debt ceiling and about the spending pattern we're on, we're going to end up with that kind of a problem and an event coming up. Now, all we did in the last 2 days is kick the can down the road. We kicked it to January and February. The debate is going to come as we get into early next year about what to do about that. And everybody has an opinion about what should the government do. It depends on whose ox is going to get gored. Nobody wants their program cut. Nobody wants the government to cut back on a program that they think they benefit on. You know, some things are fairly easy. I mean, I think you can reduce the number of employees at the Bureau of Indian Affairs, since there are more employees in that bureau than there are Indians in this country. And the Indians we do have own casinos, and they're making a ton of money. But other than the kind of simple, I'm sorry, I thought that was funny, but apparently, you know, humor's the only group you can talk about anymore in this country in terms of trying to make a joke about anything is old white men. You know, we're still subject to being picked on. Every other group is off limits. You can't say anything about them. So I guess Indians, I just picked on Indians. I shouldn't have done that. Sensitivity training is not my strength. I haven't done well with that course. So I apologize to any Indians or anybody of Indian descent. But the reality is, we're going to have that debate. I mean, at some point, and it isn't because we want to, because frankly we don't as a country. We don't want to have the debate about what programs we have to cut back on spending, or how much do we have to raise taxes. Those are the two choices, or some combination of the two. But we have to reduce this growth in federal debt. So we've got this monetary and fiscal policy war that's going on. And it hasn't gotten any better. The proposal was for $102 billion of additional spending. It was not passed by Congress because, one, we had the debt ceiling, and two, we had no Speaker of the House for several weeks. So nothing got passed by Congress. And so all they did is pass, I think it was a $14 billion package for Israel. But we haven't passed the rest of what was $102 billion spending proposal that was sent to Congress. But that's going to come up again. we're going to see that come up again. So the real question about 2024 is, who wins the war? What are we going to do about all this? Well, the reality is the monetary policy side is pretty easy, and it's because the Fed has been pretty transparent. They've been willing to say, here's what we plan to do. And so forecasting the Fed has become a much easier prospect than certainly the fiscal policy side, which I'll talk about in a minute. So for 2024, we think policy will remain restrictive. That's a real gutsy forecast because the Fed has said it's restrictive now, we're going to keep it restrictive. Which means that the 5.25% to 5.5% Fed funds rate is going to stay there for an extended period of time, which is frankly exactly the language the Fed has used in their announcements after each of their FOMC meetings. Secondly, managed rates are at what the Fed calls the terminal level, which means I don't think you're going to see the Fed raise rates any further. Now, what would cause the Fed to raise rates? A sudden spike in inflation. Inflation, as I've shown you, has come down. It hasn't come down as fast enough or as much as the Fed wants to see it come down, but it is declining. In order for the Fed to actually raise rates further from here, we would have to see a spike in inflation. Now, that's possible. I mean, it's possible that we'll see that. It's hard to see some of the contracts that are being signed, labor contracts that are being signed, and the wage increases that are coming, and not believe that these companies aren't going to raise prices in order to cover the higher labor costs. I saw a number the other day that kind of shocked me. A UPS, which signed their labor contract in August, a UPS driver, delivery guy that you see driving around, makes $150,000 a year as a driver. And you add the benefits on top of it, total labor costs are about $170,000 a year. I can't believe UPS is going to continue to ship goods at the rates they've been shipping them prior to that contract. They're going to raise that rate. The UAW contract that is barely passing, apparently it isn't even fully passed yet, would raise the cost of a car somewhere in the area of $700 to $900 per car. I don't think the auto companies are going to eat that $700 to $900. I think they're going to raise prices if that contract passes. And heaven forbid that it doesn't pass and they have to go back and renegotiate even a higher wage increase. And when the UAW signs contracts, every other union jumps behind them, says, hey, they're getting their share, I need my. So we could see a spike in inflation just because labor costs go up. Now, I'm not sure why unions haven't figured out that, you know, maybe if we raise our prices to price of our services, our labor, to such a level that the auto companies won't automate even more than they already have. Because the auto company's attitude is, we need to lower our labor content. So I need more robotics and fewer individuals to assemble a car. Somehow that idea must be lost on some of the negotiators for the union. But that's going to happen. Will UPS use drones and driverless robot cars to make deliveries so I don't have to have as much labor content? That's where we're headed, aren't we? We already see it happen in a lot of markets. So there are ways that companies can mitigate the rise in their labor costs, but that's expensive and investments. Those companies have to make capital expenditures to bring the equipment in to do that. And that takes time for them to make that transition. So we could end up with a spike in inflation, this trend that we saw of inflation coming down, spike up as these labor costs begin to affect ultimate pricing. We haven't seen it yet, but it may come. But the Fed believes that at 5.25% to 5.5% on the Fed funds rate, that is high enough to keep a lid on inflation and economic growth. I think the yield curve will turn positive. That means that short rates will decline more than any decline in longer term rates, so that we get a positive slope to the curve. What will cause that to happen is the market beginning to believe the Fed's ready to cut interest rates. That the Fed's ready to remove a little bit of the restrictive monetary policy they have in place to become a bit more accommodative to an economy that is slowing with unemployment rising. So I think the Fed has that tool that allows them to do that. And if they do, if they send the signals they're ready to cut Fed funds rates, that the market rates will come down much faster and sooner than the Fed actually moves rates. So I think we will get a positive slope to the curve in 2024. And we think that the Fed will ultimately begin to reduce restrictive monetary policy by late third quarter or into the fourth quarter of next year, of 2024. I don't think we're going to see a whole big decline in interest rates. The Fed is going to come down very slowly. They're going to come at 25 basis points at a meeting, not the 75 basis points they increased for 3 meetings in a row, but they'll come down by 25 basis points over an extended period of time. I think the fair level for the Fed funds rate in an economy that's growing at least 2% and inflation running 2 to 2.5% is a 3 to 3.25% Fed funds rate. So ultimately, I think we'll see 200 basis point cut in the Fed funds rate and shorter term interest rates, but it's going to take 1, 2, or 3 years for that all to unfold. The reason I'm a little cautious about how fast rates could come down, how much they could come down, is because the other side of the war. Because I will tell you, forecasting fiscal policy is impossible. It's impossible. Your guess is as good as mine, what Congress and the administration is going to do. Because we have this huge amount of political instability in this country. We have a situation where we have created an environment where we have all these silos. Everybody's in a silo. I'm a woman, I'm gay, I'm transgender, I'm Asian American, I'm African American. They're all silos. I'm a white man. They're all silos. And the problem is, every silo believes the other silos are taking advantage of them. They're exploiting them. And so there's no effort to reach a middle ground in this country. That I'm going to protect my silo, whatever it is, whatever silo I'm in, is what I'm going to work on, I'm going to protect. We see this happening with the protests right now with the war in the Middle East. The silos are up and walls are thick. So how do we get out of that? How do we end up with a moderate elected anywhere? Because everybody running for office is either at one end of the political spectrum or the other, extreme ends of that political spectrum. Because we have not made the decision we ultimately have to make in this country. And that decision is the federal government's primary role to guarantee equal outcomes for everybody, or is it to guarantee equal opportunities for everybody? We haven't made that decision. And until we do, we're going to have these silos and the political instability and the problems that we're dealing with. Now, I'm not suggesting that we have to go to one end of the spectrum or the other. We probably have to try to get somewhere closer to the middle of those two extremes in order to move forward, to get progress. Because there's problems at both ends of the extremes. Obviously, if you believe that the federal government should be guaranteeing equal outcomes for everybody, that stifles innovation. There's no risk-taking. There's no capital investments. The government's going to dictate how to allocate resources and who can spend money in their plant and their equipment and how much money, wages everybody can make. If we're going to say, I need to get a 40% increase in my wages because the CEO of the company made $22 million last year, obviously those silos are never going to come toward the middle. Now, at the other extreme, if you go to the extreme of equal opportunities, obviously you end up with income inequality. If you say the role of the government is to guarantee equal opportunities for everybody, There will be winners and losers in that. There will be people who are risk takers, or are willing to work harder, to make more money, to be promoted, start a company, all of those kinds of things. And there are people who won't do that. And as a result, you end up with income inequality. Income inequality is obviously absolutely a disaster to those people who think the government ought to be guaranteeing equal outcomes for everybody. So we have this conflict that in this country, and we haven't resolved it. And we won't resolve it until we begin to move toward the middle, somewhere between the two ends of the extreme, and start to try to get these silos to break down in this country. Because of that, we end up with a political instability. I don't know about you, but based on what I'm reading right now about who the likely two candidates for president next year are, my conclusion is out of 33 million people in this country, we can't find two people better than that. Somewhere there's got to be somebody willing that can do that other than the two ends that we've got going on right now. But those are the silos, and we have to deal with it. So you want me to forecast what the fiscal policy is going to be? Are we going to spend that $102 billion that was sitting in Congress right now as a proposal, all of which we'd have to borrow? Or are we going to raise taxes in order to pay for what we're spending money on? Those are going to be the kinds of issues that come up. So until I have and I don't have any real ability to forecast the outcome of those conflicts, or when or if they are resolved. So I can't say to you that fiscal policy is going to finally reach some sense of common sense and begin to reflect what's going on in this country. I don't know. Strikes and labor unrest are going to continue. We know that people are going to say, hey, it's time for me to get mine. That's another silo that says I've been exploited. I don't know how that's going to outcome. Student loans. I suspect that we're going to see another proposal to forgive student loans by the time we're done. That might be one of the largest stimulus programs we could possibly do, because you're going to forgive billions of dollars of debt that exists out there in the idea that it's fair. I'm not sure how it is, but that's what the view is. We've got wars that we're supporting. Ukraine and the Middle East are the most obvious ones, but we're fighting a war with China. It's a trade war, and it's a whole lot of things, and hopefully it doesn't escalate into an actual war, but political unrest around the world has increased dramatically. And as a result, we're going to spend money. One of the beauties is, I couldn't believe this. The President made a speech about why we should send all this military equipment over to the Ukraine and Israel. He said, that's actually good for the United States because we've already made all those tanks, and all we're doing is shipping out of inventory. And that means we have to replenish the inventory. We have to go and build tanks to replace the ones we're sending overseas. So it's good from an economic standpoint. Well, that just increases debt. I mean, unless you live in Lima, where they've got a huge tank plant, it's not like I'm going to get a benefit out of this. I'm just going to have to spend more money or taxes or something, or the debt just keeps going up. So, I mean, somehow some common sense has got to come back into somebody when we start talking like that. Consumer and business confidence. It's amazing to me that consumer confidence has stayed up as high as it is for as long as it has. People are still willing to spend money. Now, a lot of the money they've spent on goods and services in the 4.9% rate of growth in the third quarter was using up their savings. They used up a lot of the stimulus money that they hadn't spent up to this point. If you look at state and local governments right now, they're flush with cash because we've passed stimulus bills that sends money to the state and local governments. I saw the mayor of Toledo was talking about a budget for next year without any federal stimulus money. My goodness, we're back to actually paying our bills for the services that we have in a city, but we've used up a lot of that money. as an individual. That money that's sitting in state and local government coffers right now is earmarked for infrastructure. And it takes a while to get engineering, environmental studies, and everything done. So there's a lot of money left to be spent that's been sent to the state and local governments. I think, just maybe as an aside, one of the best investments you can make is go find the company that makes those orange barrels, because obviously there's going to be a huge demand for orange barrels as these local governments spend money on rebuilding bridges and roads. So will business confidence stay up or rebound actually, and consumer confidence stay up next year in light of the conflicts, this war that's going on the fiscal policy side? The more that we talk about environmental investment, the more costs are involved. I happen to have an EV. I bought an electric car. I just thought they were kind of neat to have, and they are. I just can't drive it anywhere beyond Lima, so and get back. Other than that, that's the extent. But fortunately, I don't drive all that much. But at any rate, environmental investing is great. But I started to think about this. I plugged that thing in at home and charged the batteries up. Where's that electricity come from? It comes from a fossil fuel generating plant. The amount of electricity generated by solar, by wind, hydro, is a very small percentage of the overall electricity that we use in this country. So we need fossil fuels. We're not going to flip the switch and go to solar or wind as our sole source of electricity. We're still burning fossil fuels to produce the electricity for the electric cars that people want to sell you. So what was the solution to the environmental restrictions that were put on the oil companies about drilling in the United States in the last couple of years? And you always hear that these oil companies have all these leases out there, and they do. The problem is they can't get permits to drill. They can't get them from the Environmental Protection Agency. So I got a lease here, but I can't drill because I can't get a permit from the Environmental Protection Agency. We see that conflict in Alaska all the time. So the solution was, well, why don't we go to OPEC and ask them to increase their oil production? Now, I'm not sure if that's environmentally sound, but I don't think it is. Having us buy the oil from them as opposed to us producing it doesn't affect the environment. But we have that conflict going on. Again, we got silos. We've got silos protecting everything. And finally, unfortunately, next year we've got the election cycle. And it is going to be, if you thought September and October were terrible for advertising on television and the emails and the robocalls that you got, it's going to be brutal. It's going to be brutal going next year. I got do not disturb on my phone all the time because the last thing I want to get is all those calls. I have no way of forecasting the outcome of these 7 areas. I don't think any of us do. And therefore it becomes very difficult to forecast what 2024 is going to look like. I can understand why business confidence is as low as it is relative to consumer confidence because of these uncertainties that are sitting out here. Now, we have to watch them as we go forward, see what the outcomes or what the trends may look like. But right now, I'm not very optimistic that many of these things get settled next year, that we're going to continue with the conflicts. And so we'll end up with this war between the Federal Reserve and fiscal policy as to what happens in 2024. Now, you just listened to it. How long was it? Oh my goodness. I've been up here about 45 minutes. And the basic conclusion I've reached is, I don't know. How's that for, I hope lunch was good because it was actually, it looked like it was good. Because the reality is, it all depends on the outcome of these kinds of things as to how it happens. Now, all of these things aren't going to come to roost in 2024. So, unfortunately, I've tried this, and I've tried to get citizens to pay me my fee for a forecast that says I don't know. It's difficult to get them to do that. So I have to have a forecast. So here's my best guess, and I will I'll tell you, it is a best guess. I think we are going to see a slowdown in the U.S. economy. And I think it begins here in the fourth quarter. We got a weaker retail sales number, which is extremely important for October, was released yesterday. I think that's the beginning of this slowdown in consumer spending that propelled the economy in the first 3 quarters of the year. But I don't think we end up in a recession. I think we end up next couple 3 quarters somewhere between 1.5% and 2% real GDP growth before picking up in the last half of 2024. That's not robust, but it is certainly a reasonable growth rate in the economy. I think inflation does come down, but doesn't get anywhere near 2% next year. I think we'll be lucky to get to below 3% on the core PCE price index. And therefore the Fed will be very slow to lower interest rates as they continue to watch inflation moderate, but not get to the levels they've said they need to see it. So in that environment, I think we're looking at a weak, relatively weak next 6 months of economic growth. Remember, this is all adjusted by seasonal adjustment factors. So we get the Christmas selling season, which actually Christmas selling season starts right after Halloween. If you're a woman, if you're a man, it starts the day before Christmas Eve. So I picked on 2 silos there, didn't I? I got to watch it. But at any rate, it incorporates the Christmas selling season and the seasonal adjustment factor. I guess I'm probably a little more pessimistic about the long term until I see some movement off the extreme ends of the political spectrum. I haven't seen it happen yet. I think we need to see it happen, and the only way it's going to happen is if all of you make it happen, because we have to go vote. And we have to vote. I don't know if Joe Manchin ends up running as a third-party candidate, as a moderate, but he may. And maybe that's the kind of thing we need to see happen, is to get away from the extreme ends of the spectrums that each party seem to represent. So I need to see that happen to be more pessimistic. Now, the good news for me personally is that at my age, the long term gets shorter and shorter for me. So in my definition of long term, we're going to be fine. For some of you in this room, the long term may not be as optimistic as it is for me over the next year or so. So that's why I see the economy. That's where I see the conflict occurring. Thank you.